In this recording, we're going to follow on from the live lecture now, looking at the consolidation adjustments related to a statement of cash flows as well. So before you go on and look at this now, you should be comfortable with an individual statement of cash flows, dealing with the indirect or direct method for cash flow from operating activities, and be able to work through the rest of the statement of financial position, getting those figures for investing activities and for financing activities as well. And take a look at question 1 and question 2 in the pack and make sure you're happy with them before moving on to these. This really is where we take the step up now. We take that individual company statement of cash flows and we layer on our knowledge from week 1 to week 7, which is dealing with basic consolidation issues, NCI, associates, acquisition of a subsidiary and the associated goodwill, and also we're bringing in disposal of a subsidiary as well and how that might impact a statement of cash flows. So the key principles when preparing a consolidated statement of cash flows is we're only looking at cash inflows and outflows external to the group. So any cash inflows and outflows between a parent and subsidiary, they're eliminated, like you do for unrealized profit or revenue and cost of sales for the profit or loss statement. And remember, if an entity is accounted under the equity method, you're only interested in the cash flows from an associate or JV, not the share profits. They're different things. We're only looking at cash flow for the statement of cash flows. Likewise, if a subsidiary is acquired or disposed during the period, you're only interested in cash flows post-acquisition. So all of the same principles we apply to the P&L and the statement of financial position, they are applicable here as well. And we're going to start then by looking with the non-controlling interest. So when we look at the NCI, remember you know how to account for an NCI already. We're interested in the cash flows related to the NCI. And the main cash flow you will have is where cash dividend is paid to the NCI. Usually that's the plug figure you're trying to solve for. We'll have the opening balance and the closing balance from the statement of financial position given in the question. We'll have the share of profits for the year from the statement of profit and loss, and whether there was any additional acquisition or disposal of an NCI through a subsidiary transaction during the year. What we won't have is, was there any dividend paid to the NCI? And if there was, there's a choice. Usually we put it into financing activities. You could, if you wanted to, put it into operating activities as well. It's just to be consistent year on year. So what we're going to do and how to figure out what dividends are paid to the NCI. Remember, in a statement of cash flow question, you're going to be given financial statements. You're going to be given the group financial statements, statement of financial position at the start of the year and at the end of the year. So you'll know the opening and closing NCI balance. They'll be correct. You'll assume they're correct. You'll also be given the consolidated statement of profit and loss statement for this year. So you'll know what the share of profits are. So what you're doing is you're solving the puzzle. You're working back whether you want to use a T account or whether you can just do it in equation format. That comes with practice, see which one you're more comfortable with. But you're trying to solve for the plug figure. And the plug figure will be what did you pay in cash dividends to the NCI. So I just showed you here a sample of the T account. You'll have the opening balance. That'll be coming from the statement of financial position, as will the closing balance. You can call it balance brought down, balance carried down, whatever way you want. You'll be given the information about the share of profits for the year. That will be in the statement of profit and loss. And you may or may not have an acquisition or disposal during the year. So if there's a mid-year acquisition of a subsidiary with NCI attached, that will increase the NCI for the year. If there was a mid-year disposal of an NCI, that will decrease, or subsidiary, that will decrease the NCI. And having all of those figures, you can figure out the plug figure to make it all work. And that plug figure is debit NCI, credit bank, which is the amount of dividends paid to the NCI during the year, which of course are paid from the subsidiary. So you're always working back to the plug figure. It's just using your basic knowledge of consolidation and how we approach figuring out statement of cash flow items in even a normal statement of cash flow. So we're merging together that knowledge of consolidation and IAS 7 to finish off consolidated statement of cash flows. So let's have a look at one practical example here, just a small one, and we can build this up to the longer questions in the question pack. Right? So here, the following extracts for Jarvis Group, and you'll be given these full statements in an exam scenario. Group profit before tax, the profit for the year, and then that profit year is split between the group and the NCI. So you have the share profit from the NCI. You also here have what the opening and closing NCI balances are. We're not told anything else. about acquisitions or disposals during the year. So we assume that nothing happened. So think about it, like even from a basic equation point of view, the opening balance at the start of the year, the NCI was 300. The only thing that moved the NCI during the year, which we'll see in the group or consolidated statement of profit and loss that you'll be given, was their share of profits, which are 15. So that means at the end of the year, if nothing else happened, the NCI should be opening balance plus profits. It should have been 315. It's actually only 306. The difference there is 9. Whether you do it in an equation format like that, or whether you do it in a T account format, that's up to you. Whichever one you think you're comfortable with. Sometimes people prefer the T account because they're better at getting debits and credits right than mixing up signs, positive and negative, and making a mess of it. But that's up to you. Think about it, see what works for you in the exam questions in the question pack. But again, this is just your basic knowledge of how an NCI works. Most of the stuff will be done for you. You won't be calculating NCIs or anything like that. You're given the opening and closing NCI. What you'll have to determine is what's the plug figure to make it work or to make it balance. And that plug figure usually is the amount of dividends paid to the NCI. So that means here, this 9 will be a minus 9,000 cash outflow in most likely financing activities. There is a bit of subjectivity. Usually I put that to financing activities. One other thing to flag that we didn't have in the example here is if there was an acquisition or disposal of a subsidiary during the year and you didn't acquire all of the subsidiary, so there was an extra NCI, or you sold a subsidiary with some NCI attached, that will move the NCI during the year. So there's question 5 in the question pack is a step on now. So you might pause this recording, go back and do question 5, the NCI part, just to see we didn't have that here. We didn't have any acquisition or disposal, which I have outlined up here. It was just assuming with the same subsidiaries at the start of the year, at the end of the year. If we did, it'd complicate things a small bit more. But go and look at question 5 and that and see how it differs, because you'll see that and crop up in a couple of past exam questions as well. So the next complication we're looking at, well, how do we deal with the equity method? So it's not an NCI, how do we deal with associate or JV? Again, it's the same concept here. We're only looking for the cash flow. So remember, we don't consolidate the associates' revenue, cost of sales, etc., nor do we consolidate their assets. So when it's accounted for the equity method, you only recognize the share of the JV, joint venture, or associates' profits each year. We're not interested in profits. So when you're doing the reconciliation, if you're using the indirect method, you shouldn't be including the share of profit from associate or JV, because that's not cash. So be careful and strip out that if you're using the indirect method to get cash flow from operating activities. What we're only interested in is the cash flows. So if you spend money acquiring a new joint venture or associate in the period, if you receive money from selling off a joint venture or an associate during the year, or if you receive dividends from them, then that's what you're interested in. So as I said here, we're only interested in the cash flows. The share of profit from a joint venture or an associate should be deducted when you're using the indirect method because it's not cash. It is increasing the profits, but there's no actual cash related to it. The cash will be the dividend you receive, if any, in the period. That's a tricky one. We'll see that in a second. So share profit does not involve cash flow. You need to adjust this for a non-cash item. Just like you remove profit on disposal, this is also a non-cash item. The main cash flow impact from the equity method is dividends received. If you get dividend in from associate or JV. Right? To calculate that, again, we're solving a puzzle. We'll know the opening balance, and I can show you here in a second. We'll know the closing balance, and we'll know the movements during the year. Very similar approach to dealing with an NCI. The statement of financial position will give you the opening balance, which is an asset, and the closing balance at the end of the year. The profit or loss statement will give you the share of profits for the year, which would explain some of this movement. And the notes might tell you there was any acquisition or disposal of an associate or JV during the year. So you have everything you need to figure out the plug figure. The plug figure being what dividends were received from a JV or an associate. Debit bank money coming in, credit the investment in the associate or joint venture. That's how you account for dividends received in the equity method, which is IAS 28. So very similar logic. You can use a columnar method if you want, or you can use a T account. And you'll see a good example of this in question 5. And we'll work through a small worked example now just to see how the numbers come across. So take this example where the Pripin group in the 14 are given an extract from the consolidated statement of profit and loss, where you can see in here share profit associate 30. Right? That's fine. And also you're told here the opening balance in the associate was 264. You'll be given this in the question. The closing balance was 276. So we need to know, well, what's the relevant cash flow item? This is not relevant for cash flows, this 30. It should not go anywhere near the statement of cash flows, and it should be stripped out when you're dealing with the indirect method for operating activities. So what we're saying is the opening balance was 264. To that you would have added 30, because that's how you account for the equity method. Debit the investment in associate, credit share of profits. So that means if there was no dividends paid, it should have been 264 plus 30. So at the end of the year, the investment in associate, if nothing else happened, and there was no acquisitions or no disposals of associates during the year, it should have been 294. 264 plus 30. It's only 276. And the difference, the 18, that must be dividend received, which is debit bank, credit investment in associate. And that's, you can see it in columnar format, or you can see it in T account format. So there's nothing new to what we've covered already in week 1 to 5 in AC 571. The core basics of how to do the equity method, how to account for an NCI, and layering that then into how to deal with an issue in terms of statement of cash flows. I'm a big fan, even initially, of using the T accounts because it makes it very straightforward, thinking about debits and credits, and it's a good practice as well. In terms of knowing those debits and credits for consol, because they are an examiner favourite in terms of requirements. And you'll see that in past papers asking for journal entries. So make sure you go back over question 5, looking at how to deal with an NCI and looking at how to deal with an associate as well. Exact same approach if this was a joint venture. Opening balance, closing balance, and use the profit or loss statement to help you explain the movement. Now, the other main complication you can have in a statement of cash flow question, and usually if any exam question comes up on this, you'll at least have one of either a mid-year acquisition of a subsidiary or a mid-year disposal. And we kind of touched on this already, for example, with the NCI, is well, what happens if you acquire a sub during the year? There's actually 3 broad elements to consider. The first thing is, well, if you acquire a sub, you probably paid some money. So we call that the net cash cost. How much did you actually spend in cash terms? We're not interested in shares. We're not interested in deferred consideration because none of them are actually cash. What we're interested in, how much did you pay for the subsidiary and did you get any cash on the subsidiary's balance sheet at the date of acquisition? So that's what we mean by the net cash cost. And we'll look at an example of that in a second. Likewise then, if you acquired a sub during the year, and this is tricky, well, you probably have a goodwill calculation. So that means you have to look at, well, if I acquired a subsidiary during the year, and remember, this will all be done for you. They'll give you the finished statement of financial position. Well, if there was goodwill, that will help explain the movement in intangible assets over the period. So if intangible assets went from 100 million to 200 million, a lot of that could have been the goodwill from the calculation. Or there could be impairments within goodwill. So if goodwill, if you're trying to reconcile it, you're looking at one reason to explain the movement in goodwill will be the acquisition of the subsidiary during the year. So you might have to calculate goodwill under IFRS 3 and compare it to what the closing balance is. That's a tricky one you'll see in some of those exam questions. And finally, then the impact on all the other line items is a tricky one again. We've seen that already with the NCI. If you acquire a subsidiary during the year, that will help explain the movement in the NCI, because all else being equal, the NCI will be bigger because you acquired another sub. But also, that also stands for other items. For example, if you acquired a sub, some of that sub will have property, plant and equipment. That will explain the increase. If you, for example, took on trade receivables, inventory, all of those will explain the increase in every line item. So you need to include that impact or strip it out, as we call it. So you're getting a true movement. Because technically the movement in trade receivables should be ignoring the subsidiary's acquisition, because that was nothing to do with the impact on cash flow. Same with the increase in property, plant and equipment. Some of that increase is not due to you paying money for property, plant and equipment. It's coming as part of the subsidiary's acquisition. So those are the ones we're going to focus on in the live webinar next week in some of the examples. But just to get your head around that, when you acquire a subsidiary, that has an impact on nearly every line item. And that will help you explain how the movement and opening balances to closing balances happened. And if you ignore it, you're going to come to the wrong balancing figure or the wrong plug figure. So for example, let's take a small example about the net cash cost, which is the obvious one in terms of how much did you actually buy it for. So during the period, P Limited, the parent, bought 80% in S Limited, right? And the details of the acquisition are as follows. So they got net assets of 720, which are made up of those assets and liabilities. They paid 600 and they valued the NCI at 144. So that means goodwill was 24. And they paid for that you buy cash 400,000 and issue of shares 200,000. So let's think of the different issues here. First thing is, well, there's going to be a cash outflow because you spend cash on buying the subsidiary. The cash outflow here is not 400, it's 380. Because you paid 400 cash, we don't deal with the shares because they're not cash. You paid 400 cash, but you got 20,000 in on the balance sheet at the date of acquisition. So that would have increased your cash. So the net cash cost is 380. And that will go to cash flow from investing activities. So that's where the net word comes from. You net off any cash on the subsidiary's statement of financial position. The other things to note then is, well, when you're doing your NCI puzzle and solving it, there's going to be an additional 144 on the credit side because you acquired a new NCI during the year. When you're doing explaining the movement in non-current assets, you're going to have an extra debit of 500 because that's appearing now as part of the acquisition of the sub. And when you're looking at the movement in shares during the year, 200,000 of that is non-cash related. It's related to the acquisition of subsidiary. So when you're looking at the movement in share capital and the movement in share premium, you discount that, you ignore that because you know that's not cash related. So it has a knock-on impact right throughout the question. That's why it can be quite a tricky one to get your head around. And you'll take a couple of practice questions to get up to speed on that before you go on to exam questions. A good example of that is the Glombia. Looking at note 193, you're looking at Glombia's acquisition of SlimFast. So do take a look at that. They show you what the consideration is. They show you the cash and cash equivalents, right? And they show you how to get the net cash cost. So the net cash cost, which goes to the statement of cash flows, is 313 million, which is made up of how much they spent in consideration, less the amount of cash and cash equivalents they got from SlimFast's statement of financial position at the date of acquisition. So these are real world examples of using this knowledge from IAS 7. So it's no harm, go back and have a look at that, a little example to see how we got the consideration in cash terms, how much cash you actually got when you acquired the subsidiary, because most subsidiaries will have some cash on their balance sheet at the date of acquisition, and that becomes then cash part of the group. So you're essentially buying that as well. So that's why we look at the net cash cost from the purpose of the statement of cash flow. What's the net cash outflow, which is 313 million in that regard. All right. So again, take a look at that and particularly take a look at the other items. You will have further adjustments. So for example, property, plant and equipment, right? For example, inventory, trade payables, taxation, all of those items are going to be impacted by the acquisition of the sub. But you need to adjust for those when you're determining the cash flow items because they'll give a false reading. Because you might think, oh, hold on, there's been 100 million spent on property, plant and equipment. I'm going to put that to cash flow. Maybe 50 million of that is because you bought that through a subsidiary. That's not cash flow related. So you're going to have to deduct out the movements due to the subsidiary acquisition first. And we're going to look at some of those in the live webinar next week. We'll maybe have a look in advance at question 3 and question 5 to see what I mean by that and how the workings are actually done. You're stripping out the impact of the acquisition. Right? Exact same approach when you're dealing with a disposal. In this case, you have a net cash proceeds because you're selling your subsidiary for a certain amount, but you might also be giving away cash on the subsidiary statement of financial position. So it's the net cash proceeds that we're looking at. Likewise, goodwill may be removed. So you have to deal with that and help explain the movement in goodwill in non-current assets. And you also have, for example, removal of property, plant and equipment, removal of inventories, payables, NCI. And that will impact each line item as you're trying to explain the movement between opening balance and closing balance in the consolidated statement of financial position. So it's just the opposite to the acquisition of a subsidiary. So to get used to that dynamic is important because that's something you wouldn't have come across in normal single company statement of cash flows. Give you a little example. During the accounting period, P sold 100% of its holding in S. So there was no NCI, they owned the full amount, they sold it for cash. And at the date of disposal, the net assets were 160,000. But you're selling it for 140. So straight away we're thinking, hold on here, here's an added complication. We have a loss on disposal. Because we're selling something that's in the accounts at 160, it's net assets, selling it for 140. So like you have a profit or loss on disposal of non-current assets, you have a profit or loss on disposal of a subsidiary, which we had 2 or 3 weeks ago. So that will be a non-cash expense. So you're going to have to add that back when you're doing the indirect method. So these are little cheat sheets that you'll put down. And remember, look on your loop page. I have a 1 or 2 page or Excel file with all of these little cheat sheet notes in a nice succinct order. That'll help you trying to figure out the key things for each line item. So do take a look at that. It is up on loop. The other thing you'll take away from this is, well, I'm after selling it for 140. That's a cash inflow. But at the date of disposal, I'm after getting rid of cash on the subsidiary's balance sheet of 14. So I'm up 140 and I'm down 14, which is a net cash proceeds, the opposite of your net cash cost of 126. And that will be a cash inflow in investing activities. So things like that are quite useful in terms of getting an idea of what way to lay it out. Disposals, you have to watch out for a profit or loss on disposal. Acquisition, you don't have a profit or loss in acquisition, but you have to be careful of what the net cash cost is. And similar to the acquisition of subsidiary, the disposal of a subsidiary is every other line item you need to look at. The impact of a disposal on NCI, the impact of disposal on property, plant and equipment, on inventory, etc. All of that has to be captured. So it makes it a bit more complicated of an exam question when it does come up. And there's a full work example of that in question 4. The other thing that's a very good, and I think I might have referenced it here at the back end, just for people, I don't have a reference, but if you want to take it down, is the Mahoney textbook. I've mentioned that a number of times in the live webinars. The Consolidated Financial Statements by Niall Mahoney. It is an excellent chapter on statement of cash flows, consolidated statement of cash flows, as does the Connolly textbook. Both of those are available in ebook format. So the purpose of this week is really to focus in your knowledge on the consolidation adjustments. Go back and look at example 3, 4, and 5. And if you get those done for next week, you're in a very good position. Certainly go on if you can look at question 6 as well. That'd be great, but don't put yourself under too much pressure. Look at the examples from class. Look at example 3, 4, and 5 in the question pack and have a look at one of those chapters. The rest of this deck then we're going to pick up next week, which gives you the key steps, how you might approach a consolidated statement of cash flow question. And we're going to do a full exam question in class next week, just to see how we work down through each of them and how we pick up the key information. Right? But as I say, your key tips in terms of a statement of cash flows, focus on the basics first. Be able to do an individual statement of cash flows, which is question 1 and question 2 in the pack. Then worry about the group accounting. How do you deal with the key areas that regularly come up? The acquisition or disposal of a subsidiary, key issues around the equity method, dealing with joint venture or associate, or dealing with NCI. If you want to, by all means use T accounts. Some students like them, other students prefer to use the Collimer method because they're happy enough they can do it quite quickly. But that's fine. Whatever way you want to do it, as long as it works for you. And remember, the hardest thing when we deal with consolidated cash flows is to linking all the items together. That's the trickiest. Linking a disposal of a subsidiary to the goodwill. Linking a disposal of the subsidiary to the profit or loss on disposal. Linking a disposal to NCI. There's a huge amount of things that go on. And the best thing is to have that cheat sheet in front of you. The one that I have up on the Loop page. Have a look around it. You might print it or update it yourself. That's why I've given you an Excel format. You can update it as required as well. Right? But certainly it's important that you put a bit of work into that you grasp it early on. Not the worst area of consolidation. There are some small amount of disclosures under IAS 7, but nothing that you haven't covered before. Right? So that's relatively okay. I'm not too concerned about disclosures. They're relatively easy covered yourself, and you'll see those in the model financial statements or any of the sample financial statements I've given you on Loop. What I'm more concerned about this week is grasping the basics. How to deal with cash flows related to NCI, how to deal with cash flows related to the equity method, and cash flows related to a mid-year acquisition of a sub or a mid-year disposal. And if you can grasp those, and you can do question 3, question 4, question 5 in the question pack, you're well set up for next week. Then have a look at the email and I'll tell you which of the exam questions we're going to go through from start to finish in the second half of next week's lecture.